All right, it's preparing. And we are live. Let me just finish setting up, but we should be good to go. So, and then let me just do this, and we're good. All right, welcome everyone. As you guys are rolling on or watching this afterwards, this is Chit Chat Money, our guests here today, and they're here to talk to us about a stock in particular. I won't even say the ticker or the name of the company. I'll let them do that. But we actually filmed an episode yesterday. And if you haven't seen the episode with Andrew where he pitched Paylocity, go check that out on their YouTube channel or on Apple Podcast. So before we get started, you guys want to introduce yourselves?
Yeah, so my name's Brett Schaefer, one of the co-hosts over there. And yeah, if anyone wants to hear Andrew or Fabio, we had him on once. My light's going crazy here. I'm going to turn it down. It tends to do this for, I don't know. I don't know what happens, but the Zoom settings go crazy with this. But yeah, yeah, go listen to those episodes. My name's Brett and Ryan's the other guy right there as I try to fix
Yeah,
this.
I'm Ryan. We host Chit Chat Money, and yes, we've had Andrew and now Fabio on the show. The show with Fabio will come out. I don't know when people will be listening to this, but it'll be coming out Thursday, the tomorrow as of recording. So Thursday, September 14th, if you want to check that out. And then yes, the one with Andrew was I think 2 weeks ago now.
Yeah.
But yeah. And I guess we should introduce the company, huh?
Yeah, what is the company?
So it's not very sexy, but it's Sprouts Farmers Market. It's unique. It's basically a specialty grocer. I think you could categorize it as sort of a small cap, maybe a mid cap. They have 400 stores now. They actually just opened their 400th location across the U.S., but it's predominantly the southeast and the southwestern United States. So a lot of stores throughout San Diego, a lot of stores throughout the Arizona area is really where they got their start. And they've been opening a lot in Florida. And that's the basics of it. Brett, do you want to go through maybe the actual store concept and kind of what the shopper experience is?
Yeah, so we did a little bit of a report, kind of just a tease on how we do our episodes. We sometimes just interview each other, me and Ryan, back and forth, and we'll send you guys a link of the show notes that we did for that, which will basically base this off of. But yeah, I'll just talk about basically what they do. And just for reference, again, the ticker is SFM. So Sprouts, or we'll just call it Sprouts for short, is a grocery chain. They're focused on serving healthy and what they call attribute-based items at a reasonable price. So if you want to think of it as a combination of little stores that you are well aware of, I would say it's a cross between Whole Foods and Trader Joe's, where it has the healthy focus of a Whole Foods, but at the more reasonable price point of a Trader Joe's. And then they add in a little bit, which I'll get to with some of the stats here, of the private label brands that Trader Joe's is known for, but just not as intense, not like 80% plus, 90% plus that Trader Joe's has. So if you look at their store layout, it's actually going to be quite different than a traditional grocery store. So they're going to have what they call a reverse store layout. It has a large area for produce, bulk, and what they call an innovation center, which is basically just samples right in the middle of the store, as opposed to when you walk into a Kroger, you're going to have those maybe 20, 15, depending on the size, aisles of those grocery shelves right in the middle of the store. And then the grocery aisles, there's only going to be a small amount of them, maybe 8 or so. They're going to be in the outside. So it's a more open layout, a lot more maybe inviting for someone who cares about, kind of exploring for different options, fresh produce, stuff like that. And their focus is, and this is their main selling point to get people into the doors and be loyal customers, is selling produce, organic produce, maybe local produce, unique stuff at a very reasonable price. That's really where they're going to try to drive their loyalty. And then other stuff is they're only going to hold a small amount of grocery SKUs or SKUs. And then before we kind of get into some of the details here of what makes their business model unique, is that they have a large vitamin and supplement section, which actually helps with their margins as well. Maybe some of your listeners or viewers are going to be like, okay, what are attribute-based items? So that basically just means food items focused on people that have either by choice or by allergy a dietary restriction. So this could be, gluten-free, dairy-free, vegan, paleo, vegetarian, you name it, whatever's popular at the time or whatever, a lot of these are still popular. They're going to be prevalent throughout the store. I think they mentioned that if for their dairy section, they just have a ton of different stuff, which some people are very, they're going to be very happy that it's there, because if you go to a Kroger, you might not find some of the stuff, and that's who they're targeting. I believe it's the 10 to 15% of the population that really cares about this stuff. They say it's either the people that are searching for this type of stuff or people that are looking for healthy food at a reasonable price. And then if we want to look at, am I able to share the screen here?
You should be able to. Am I the host now? Do I have to allow just anyone to?
Yeah, let me try. It says disabled. Maybe if.
All right, let me see if I can allow that. Because Fabio, you made me the host, right?
You're on mute, Fabio.
Here, I'm on mute now. I'm gonna give Brett.
Oh, so you're the host. Okay.
Allowed to record the files. I think that has to be in the settings. I haven't done that yet.
I
So I'm
think
just
if
gonna
you
make
click,
you. I made Brett host. So
Okay, let me
Give
try.
him
Yep.
power.
Okay, I could do it. All right, and this might be a little bit of overkill, but we do have a store layout here for anyone that's interested. Any of the watchers, as you can see, they have the opening in the middle, and then they're gonna have the grocery section that's small on the side. They're gonna have the deli and meat and seafood, as most grocery stores have, and then they're gonna also have the big vitamin and supplement section. For anyone that's watching. Well, I don't know if you guys do it in podcast format, but for all the people that are watching, you can kind of look at this, and we have that in that free link that we'll include as well. And then a couple other notes as we kind of get into what the business model is. I think a few important things from an investing perspective is that, and this might be different than some of the traditional grocers, which will probably make the easiest comparison to a Kroger, as that's kind of the standard grocery store model out there. So one, its e-commerce business has actually grown substantially in recent years, even despite the pandemic pullback. So if we look at their e-commerce, which is driven by their own stuff and as well as a partnership with both Instacart and DoorDash, they have a e-commerce in 2023 right now at 12.3% of sales versus 9.4% in 2020. And then second, which is also kind of key to the margin profile here and how we think it's going to improve over time, is that the in-house Sprouts brand now makes up 20% of sales versus just 14% in 2019. And then third, they don't carry any major CPG brands. So you can't find a Coca-Cola, you can't find Goldfish, et cetera, in a Sprouts store. And that gives them better negotiating leverage with their suppliers. They're not going to get squeezed by Coca-Cola, Pepsi, Procter & Gamble, et cetera. And that's what allows them to have a higher gross margin than a Kroger. Ryan, you're going to, any add-ons, sir?
Yeah, I'll just say it really is not a typical grocer. Like if you walk into the store and you're expecting a Safeway, a Kroger, Fred Meyer's, anything like that, you're going to be disappointed. The CEOs even talked about that before. People come in, they're like, where on earth is the Coca-Cola? Where's, like Cracker Jack? I don't know if people still eat Cracker Jacks, but where are the name brand stuff? And you're not going to find it. It's a very unique experience, and it's targeting the health enthusiast. So really 70% of the products they sell are actually attribute-based items. So gluten-free, dairy-free, vegan, I'm trying to think of the other ones, vegetarian, anything along that line, that's 70% of the items. And so it really does target that demographic. And it's not, if you look at Sprouts gross margins, Sprouts has, I think, 37% gross margins over the last 12 months. That's extremely abnormal among grocers. If you look at Kroger, if you look at literally any of the public grocery stores, whether it's Walmart, Kroger, Weiss Markets, Ingles Markets, all of them, they're all in the 20s. And the reason they're able to generate that level of gross margins is because price is not really what the customers are coming for. They want unique, local, fresh products, and they're prioritizing their health first. And so it's really kind of a supplement to the bigger grocery chain. It's not the first store you're going to go to if you need a full grocery load. It's more, I know there's some unique products that I can get at a Sprouts. And so they're able to source them from local suppliers at better rates than they would from the big CPG brands. And then they're able to sell them at attractive markups because their customers are really coming there for the uniqueness and really the fresh, high quality produce and items they provide.
Yep. And the key is that it's still not, the price point is still significantly below a Whole Foods. I remember we used to have a Sprouts around where we live in Washington. It is one of the ones that they closed because of the new strategy of consolidating around their key regions, but it's still significantly cheaper than a Whole Foods. So it's not like they're trying to go for that premium, price point and compete directly with Whole Foods. They're going for that. It's maybe the Venn diagram of people that want to eat healthy, but don't have an unlimited budget.
Right.
And they're small stores. Oh, sorry. They're small stores. Like they're not big. I think the average grocery store is like 60,000 square feet. The new stores they're launching or opening are 23,000. So it's relatively small. The sales per square foot are well above most of the typical grocery competitors because of that small store base.
So
Off the top of your head, do you know the size of an Aldi or Trader Joe's or even the average size of like a Whole Foods in comparison?
So I'm going to say, no, we don't have the numbers on the top of our heads, but I'm going to say a Whole Foods is going to be significantly bigger typically. And then a Trader Joe's would probably be closer to that. So I'd say it's more close to the Trader Joe's model of really tightly packed. And they actually have gone through a transition over the last few years with the new management team, which we'll talk about that later because it's really key to the story. Is they went from 32,000 for their standard layout square feet, and now they're going 23,000 square feet, so they're going even smaller, hopefully to increase their returns on invested capital, because I do think, given their unique model, given how they're not going for a wide array of items, it's these specific items, they can go for a smaller amount and still really get the same revenue out of their core customers.
So does anyone else here shop at Sprouts? Because I do.
I have, but they closed the Seattle stores.
No, I know. So everything you're saying is like exactly correct. So first of all, where I'm out in the Southwest of New Mexico, like Whole Foods wouldn't work here because of price sensitivity. And then Sprouts I'm the customer exactly right. Like there's some things that we get from Sprouts that you can't get from, or you can't get from Walmart. Maybe you can, but it's just hard to find like some kind of more like unique, like you said, like the non-Coke kind of thing. So sometimes my wife will be like, hey, I'm trying to cook XYZ. Can you get these things from Sprouts? Or even like their sushi's are not bad. So like you'll stop by, you'll pick up sushi on the way home if you don't feel like making dinner. And it's actually interesting. So the layout that you put in that diagram, that's exactly how the store that I walk into is. So are all their stores exactly the same? Or like
I believe so. Yeah, they're really going for a standard model here. And the new CEO is the old US VP of grocery at Walmart. So they had and his name is Jack Sinclair, for anyone who wants to do any research. Over, say, the last 20, 25 years, Walmart really did much better at grocery. I don't know if anyone has been a shopper there for a long time, but I guess just reading up on it, this wasn't from any personal experience. They've improved their grocery experience over the last 20 years. A big thing of that was Sinclair really improving the fresh produce, really improving the supply chain. He's trying to bring the same model over to Sprouts, obviously with the different spin on the brand. But yeah, he's going for this very standard model, sticking with that stuff. And the key is the openness in the middle, because I think that really helps with, I don't know if they're bragging about NPS scores, but the customer happiness when you walk into a store versus a Kroger. Like when I walk into a Sprouts or something like that, and it's open and you can kind of see everything that's going on, versus the crowded Kroger that feels like you're so cramped inside. That's not going to be a game-changing difference here, but I think it actually really helps with the customer experience.
Also, like for myself, just speaking from experience, the employees are a lot more helpful in like going out of their way. So I've had it happen several times. I'm like looking for something, and an employee walks by and like, you look like you need to help finding something. Because like my wife's like, find this like, Asian kind of sauce thing, and I'm like looking for her. There's been a couple times like the checkout line's backed up, and then employee comes in like, hey, come over here, like I'll get you at the. So like very much to your point, focusing on being more of a higher, like you said, it's not a Whole Foods, but it's more expensive, more price, kind of customer that appreciates that stuff that a Walmart customer probably doesn't care as much about. I shop at both, but like you know. A question I have is, their margins, you think, are sustainable at this level, or do you think that they're going to eventually return to the mean with Walmart and the other grocers?
That's the big question. Yeah, Ryan, do you want to hit that one?
Well, I'd say people were asking the same thing kind of throughout, even prior to 2020, but especially during COVID. They've maintained 35%, I think, on average gross margins for, I want to say, just using Y charts, like 5 to 10 years, or at least since they've been public. And there's actually, it's probably worth getting into the history here. I think in 2015, they hired a CEO. He was actually the CFO prior, but he stepped up as CEO. And during his tenure there, it was really, it was kind of a rough stint, but he really started to go after big expansion fast and doing it with leverage. And part of the way they did that is Brett mentioned that they launched these stores in Seattle, and they have these concentrations and distribution centers around the Southeast and the Southwest. And launching that store in Seattle, you're going after a different demographic, but no one really knows who you are. And so that was a big problem for them. And one of the ways they tried to combat that was throwing out these physical handheld coupons in the mail to everyone. And that's the kind of customers they ended up attracting. They call them these coupon clippers, which it's really kind of the lower margin customer. And so
just copying the other grocery stores. They're not differentiating themselves.
Yeah, not to mention that Seattle one specifically was not anywhere near a distribution center. So they've now consolidated the strategy to the point where every store needs to be within 250 miles of a distribution center. If you don't have that, you can start to see a lack in quality, and then it kind of ruins the brand, especially in those new expansion areas. And so he kind of levered up, and it kind of brought down the gross margins. And so when Jack Sinclair stepped in, they actually talked about this on a recent conference they did, where they knew they were going to fire 20% of their customers in a quarter. And so they made the conscious decision to do that. They stopped the coupon clipper customers, and they said, we're going after the health enthusiasts. We're going to lose shoppers. We're going to lose foot traffic, but it's worth it because, and the CFO, well, he's now departing, but the CFO basically said, in grocery, margins are a choice. You can either sacrifice the foot traffic and collect higher margins and sell niche products and get those higher margins, or you can kind of go the other way, which is the stack it high, sell it cheap, sell it fast Walmart model. But I think Sprouts will be able to probably maintain, maybe it's not going to be 37% forever, but mid 30s, just given their unique customers, their unique suppliers, and what their customers are really after, as opposed to the typical shopper.
Yeah, and if for anyone watching I have some charts up here that kind of shows this change. So I don't know if Ryan mentioned it, but Jack Sinclair, the new CEO, did come in 2019, and now 2020 kind of made it weird because groceries, every grocery chain did significantly better in 2020. But as you can see, their operating income has grown from that pre-COVID level. And some people might attribute that to COVID, but we actually think it's because they made this change in strategy that Ryan was describing. And if you look at their operating margin from 2016 to 2019, it was significantly declining. That's because they're going after these coupon clippers with saying like, okay, $1 for a pack of oranges, something like that, right? They totally cut that out. They totally cut out all paper marketing. And now they're going for email campaigns only, building up these Sprout membership accounts ever so slowly. And now their operating margin has recovered to just under 6%. And that's kind of where we think the steady state can be, especially as they get back to comp store sales growth. I think I have a chart of that here as well. So if we look at, again, pre-COVID, 2016 to 2019, their comp store sales growth was actually declining, even though they were going after these low margin customers. Now, if you look at 2020, their comp sales exploded like every other grocery chain. 2021, we saw the actual effects of them sacrificing a lot of these customers. So they lost the comp sales, but as we can see above here, their operating income was actually significantly higher than 2019. So we think it was a good sacrifice. And now we look at the last 2022 and the start of 2023, their comp sales are starting to grow again as they're getting to a more healthy and sustainable customer base.
So
What do you think? What do you think long run comparable sales growth looks like?
That's another tough question. I don't have a great answer for you. I'd hope it's as high as possible, but I don't know, Ryan, you have any? I'd say 3 to 4% is kind of what they target, and they're at about 3% right now.
I do. I
Yeah.
think I do broadly believe in the gross margin stability. I mean, I think, Whole Foods seems like a pretty reasonable comparison. And, prior to Amazon's acquisition, they were mid 30s in gross margin. So it doesn't, that's obviously the products that they're selling are not price, like customers are not price sensitive to the same degree that, a Kroger brand would be. But I do have, I guess one question I do have is who are they gaining share? Like, is there a share gain story here? Like, and who would they be gaining share from? Like, who are they targeting to win over?
Or go ahead, Ryan.
I was gonna say, they know who they are. They don't think they're the primary grocery store for families, and so they're not really trying to compete with the Krogers of the world. They are trying to be complementary to those, where maybe there's, I don't know, 5 or 6 items on your grocery run that you'd rather get at a Sprouts, or like Andrew said in his example, maybe there's specialty items where it's like you could have gone for the kind of name brand thing at Kroger, but you're going to take that one specialty item and go to Sprouts Farmers Market instead. So maybe they're stealing share on the edges from the big grocery stores. But I mean, I guess it's really against just wherever the health enthusiasts were shopping prior. They don't really talk much about, I guess, stealing share, given that it's such a big industry.
Yeah.
Yeah, I mean, I could see the taking from Kroger. Kroger itself is obviously reaching out to that same customer. I think the last time I looked at it, Kroger is actually like the largest organic food seller in the United States on their like Simple Truth brand. But I mean, I could see that that almost being like a gateway drug for kind of your typical grocery customer that gets interested in that type of product. But I guess I'd be curious, like, think about like a customer that goes to Whole Foods for these types of specialty items. Like, is there a reason why, or what would their angle be to capture that customer versus Whole Foods?
Yeah, maybe Andrew. Yeah.
I would jump in. It's the local. Like, is Whole Foods as local focused? I don't think they are.
Right.
And like,
Especially after Amazon.
That is a huge focus for a lot of like health people right now, is like locally. No, I think there's like a downside to that too, which I'll ask about maybe later. But
well, at least in my Whole Foods, I mean, there's a relatively decent focus on local at the Whole Food stores that I've been to. But
the other thing I'd add, or Andrew, go ahead. Or okay, the other thing I'd add is, and I think you could probably find any survey to support whatever you want to believe, but there seems to be a growing trend moving towards, in terms of like growing the health conscious consumer, where you're seeing more people go vegan, you're seeing more people adopt paleo or vegetarian diet habits, and there's tons of surveys and data out there that kind of supports that. And so like you mentioned, Kroger, they might be seeing a lot of adoption in their organic products. I think it's just a growing category as a whole. So I wouldn't necessarily say it's, zero sum. I think there's room for multiple winners in the health focus category.
Yeah, I just had a couple things there. One, we'll probably talk about this in a separate section, but the key thing is growing their store count because they're only in a couple parts of the country. But two is that, okay, when like Kroger can say they have organic stuff, right? But if you go to a Kroger versus you go to a core Sprout store, which is right close to their distribution centers, one of the ones that they're trying to, utilize going forward, or that same sort of model, the quality of the produce is not going to be nearly as good. And they focus on this intensely. Like, they make specific in their distribution centers, these ripening rooms and stuff like that. So, you get the examples they use are avocados and bananas, which can be kind of fickle, right? They want those to be pristine, not, moldy, not super, unripe or too ripe, right? Once they get into the store. So that is a clear difference for a few people, right? Or a good chunk of the population, where you can go to a Kroger and you could say, okay, yeah, it's organic stuff, but it's not going to be nearly as high quality. And at the Sprouts, where they get the customers in there with the produce at, it's going to be low margin on the produce, but at a very low price, probably just as cheap as a Kroger. I believe they say they're only slightly more expensive than at Walmart. It's going to be super high quality. And that's something that they didn't really market around very well in the past, but the new management team has fixed this, and they're doing, local TV ad campaigns. They're doing email marketing, all that good stuff around their local fresh supply chain with the produce. And we think with that marketing angle, they can really reinforce that among their customer base and among their target geographies over the next, I don't know, for however long into the future.
And you talked about how they used to have a decent amount of leverage. I can see from previous years. In 2019, they peaked at about almost 550 million, and now they're down to, last report, 175 million. That's really interesting. What are the bears afraid about? Because I'm seeing a pretty high short interest here. So what's the bear thesis on Sprouts? Is it margins, or is it something else?
Yeah. So I think the gross margin is one that we see a ton, and I think that one is easily explainable because, like with the stuff we just said. And the other one is comp sales. So their comp sales were, I think if we look over the first half of the year, I don't have the data in front of me, I think it was slower than Kroger. They have benefited from inflation, right? And their comp sales still aren't extremely impressive. They just got back to 3%. But what our thesis is that, look, the comp sales they were going to be kind of lagging, kind of like they were stuck in the mud a bit, because they did that on purpose to sacrifice some of those coupon clippers that they lost. Another thing that they argue, and this could just be an excuse, and it is something we worry about, is that people did consolidate their grocery store runs during the pandemic. That definitely hurt Sprouts in the 2021, early 2022 time period. We think that probably gets normalized here, and maybe is normalized. But I think the biggest thing for people, or at least bears, would be the comp sales, because they would argue that they're getting an artificial, or just, a kind of a one-time boost from that food inflation last year. And that's not going to repeat. So that could, be a big headwind to comp sales.
The other thing I think is worth mentioning is, in that recent conference they talked about they're getting double-digit comp sales across their expansion markets. So a lot of the stores that were open within the last 3 years, they're seeing double-digit comp sales. But they had basically there was this kind of stagnation in the store base, because they had all these mature storefronts located in, Phoenix and San Diego, and I think they now have 10 in Tampa, where you're going to get basically mature grocery store comp sales. It's not going to be anything sexy. You're going to get 3-4%, probably basically food inflation. Meanwhile, they were basically cutting out all these unproductive stores and adding a new one. So you're getting basically the maturity, the mature stores comp sales. Whereas now, as they're on pace now to do 10% store count growth in the next 2 years. They said they're planning for 30 this year and 40 next year. I think you're going to start to see comp sales trend up, assuming those expansion markets follow what they've seen over the last 2 to 3 years. So I don't know if that will hold for the next 5 to 10, but it's probably not a comp sales story here, I guess. It's not going to be anything like I don't know, Lululemon
Costco
or something like that.
Yeah, it's not gonna be Costco comps. I mean, this is not as good of a business as Costco. It's not. But we think it's one where there's just a lot of potential for them to improve the business. So we think the management team really is the right one to do it. I think that's what. I would add, though, when Ryan mentioned the store count opening, they just hit their 400th store, just for any reference for anyone watching.
Okay, so yeah, that's in line with that 10% figure. What is their capital allocation strategy looking like? I believe they don't pay a dividend, right?
Correct.
That is correct. Yeah. So let me get just my notes here on this one, because they really have two different things.
I think there's a share cannibal story here, isn't there?
Oh yeah. It was definitely for our show we did, and Fabio, you're adding to it. I think it'll be out when this comes out. Basically, it'll come out tomorrow. Is another share cannibal, Murphy USA. But yeah, we did that as a theme last month. Sprouts was a part of it. So they just have really it's a pretty simple one, which we enjoy, which is they have two things that they do. One, they look to reinvest into new stores and then into their supply chain and into refurbishing the stores, which, as we mentioned, they're converting a lot of stores from that 32,000, or I guess it's pretty slow, but they're converting, some of the stores each year from that 32,000 down to that 23,000, and then all the excess cash, they just buy back stock. So maybe a good chart to look at first would be this CapEx spend as percentage of sales. Let me just share the screen here quick. And then maybe Ryan can get it to the buybacks and the share count. So if we look at the pandemic period, they really decreased their CapEx because the supply chain stuff was hurting them on. They mentioned things like they couldn't get, a door or something like that, or checkout stations for new stores. So they really had to slow down their store count growth. And if we look at this chart here, like they spent in 2021 only 1.3% of sales on CapEx. But if we go into next year, they're guiding for 3.5% and then 3.5% in 2024 onwards. So they want to spend about 3.5% of sales on those capital expenditures. And then the rest of it, as maybe Ryan can talk about, goes into repurchasing stock. And yeah, they don't pay a dividend.
Yeah, it's kind of like fortuitous for them because they haven't been able really to put the money into CapEx that they wanted to because of a lot of the supply chain delays. So getting like proper refrigerator products and stuff to like build out their new stores. There was licensing problems, but two, there was supply chain delays during COVID. And that just so happened to coincide at a time when they were generating a ton of cash flow. And I think they were valued at like, at one point it was like 8 times earnings, but I think on average during that time is probably around 10 times earnings. And so they were able to buy back 40% of their stock now since 2015, but really a lot in kind of the last 3 years. And now it's kind of funny because now they are planning to ramp up the CapEx on new stores, which means it's going to be less cash for the buyback program on a percentage basis. So, and it's coinciding with a time when the valuation has crept up a little bit. And so that's actually kind of the more useful, I guess, deployment of capital, I'd say. So over the last 12 months, just for figures, they generated 460 million roughly in operating cash flow. They used about 37% of that operating cash flow for capital expenditures. So new stores, retrofitting some old stores, and just kind of that general maintenance CapEx. And then they just plow the remainder of that into buybacks. And I think we're going to see that start to flip flop over the next few years now that they have kind of the plans in place and the locations already picked out to start to ramp up that CapEx on new stores.
Yeah. And
so less of a buyback story, unless the valuation just plummets, less of a buyback story.
Yeah. So we do like that. And then as we did mention briefly earlier, they did bring down their debt, which they had some pretty low cost debt. So we didn't think it was, maybe they could have kept that on the balance sheet, but the balance sheet is a lot cleaner now, and there's not really much debt to pay down. They haven't really talked about paying it down, and it seems to be fairly low cost, but they have, as Ryan mentioned, plenty of cash to take care of that small amount of debt they have remaining on the balance sheet.
Yeah, I really liked that when I saw that. I did not know that they had deleveraged so much. So also, I think that's a good thing because going back to the buybacks, because, kind of one that I'm looking at right now as a near term, or well, actually there's two. There's one that's even worse of a failure. I don't know if you guys have checked out the ugly duckling of AutoZone and O'Reilly. What's their name? Advanced Auto Parts.
Advanced, yeah.
They bought back so much stock at really elevated prices. That buyback program looks terrible right now.
Well, hey, Bed Bath & Beyond, that's kind of the poster child of that.
Yeah.
How can we forget about Bed Bath & Beyond? So I think that's fairly okay. And, the market's right now rewarding their strategy. They're getting, well, actually, I took a brief look at Kroger. So Kroger is actually flat on the year, and Sprouts Farmers Market is actually doing quite well. Let me refresh my memory on Kroger. Yeah, Kroger is only up 1.44% year to date, and Sprouts has done really well. So would you say that Sprouts is experiencing this re-rating due to a lot of those things that you guys are saying? The market's starting to realize that hey, those gross margins, they're not necessarily temporary. The shorts are wrong in this case.
Yeah, and I think as well the operating margins, because I think one of the big things to reiterate is that if you look at that chart of operating margins, people could kind of look at that 2019 or 2016 to 2019 period and then the 2020 and 2021 period and say, oh, wait, their margins were just elevated because of COVID, but it actually wasn't because of that. And then I would also say the expectations in the stock were quite low. People were extremely pessimistic about any sort of comp store sales growth. And I think maybe with Kroger, there was a bit more of a middle of the line, like, okay, yeah, they're going to basically grow around food inflation. Their position in the marketplace is fairly stable, but Sprouts was a lot more uncertain. So I think as we've seen that come in on the upside, that's probably why the stock is up this year. But we still think, the valuation is not as cheap today. And maybe we can go through some of the numbers later, but we still think it's fairly compelling at these prices.
Yeah, the other thing is like walking this back 2 years, there was a lot of uncertainty around 2 to 3 years, a lot of uncertainty around what was going to happen here because there was in some ways kind of a business model pivot, right? I mean, anytime you get rid of 20% of your customers in a quarter, you're taking a pretty big risk. And so I think it deserved the discount then, and seeing that they're kind of starting to iron out some of those uncertainties over the last 2 to 3 years, I think it's just giving maybe investors a little more belief.
And now there's the clear path to growing the store count. They have, I think Florida is probably the biggest one, but they're also going to Mid-Atlantic, kind of the New Jersey, greater New York City area, or not New York City, New York State area, probably not in New York City, but there's just a clear path now. If they've shown the comp sales in Florida that this model can expand outside of the Southwest and California to the entire country.
Okay, so that's on. I have some questions that are actually coming from the audience here. So mainly actually centered around the competition, or what are your guys' thoughts on competition? You guys touched upon that a lot, but in particular, I'm getting Kroger, Albertsons, and then, is Sprouts positioning themselves in a way to combat the likes of Amazon's encroachment in the future? Is typically a question people have. So I'm just reiterating their questions there.
Okay, maybe I can hit Amazon, that one, and then Ryan can hit Kroger. They're somewhat related, but not really. It's mainly the kind of the big box, most efficient, just whatever, the biggest scale players out there. When we were looking at Sprouts back in, and we kind of looked at the 2020, 2021 time period, Amazon was one of our biggest, I guess, risks to watch out for. They had said at the time that they were investing a ton in the Amazon Fresh stuff. They had that automated checkout stuff, and they were doing, I believe, maybe another brand of a grocery store. It's kind of hard to tell. They experiment with so many things. And obviously they had bought Whole Foods. They had the, fresh delivery stuff. But as we've seen the results come out, and, we're Amazon shareholders, so we followed this. They've really not succeeded at all with their execution on grocery. Has been pretty poor outside of the, pantry goods that you can buy online. Whole Foods hasn't really had much synergies with this business besides being, I think, some places you can drop off, your return packages. And yeah, it's probably done well for them. But if you look at the actual in-store experience, if you look at their closure of Amazon Fresh stores and stuff like that, they haven't made a dent at all. So we kind of think of it as kind of inverting it and say, like, okay, Amazon, I believe, bought Whole Foods in 2017. If that didn't affect Sprouts' business model then, why is it going to affect it today? And it is something to watch, but I don't think that the people that are looking for kind of that, okay, I'm going to go shop at this place, I know they have the specific vegetarian items that I want. I know that they might have some things that kind of pop up from time to time, similar to a Trader Joe's, that, ooh, this is kind of a new thing I can try. That's not someone that just wants to have a subscribe and save on Amazon, or, they might have shopped at Whole Foods already, but that's not actually the customer that Sprouts is targeting. They're really not competing with Whole Foods. They're going after a similar health enthusiast, but it's really bifurcated. Okay, we want the ones that are cost conscious. Whole Foods wants the ones that are not cost conscious. And maybe Trader Joe's is the biggest competitor. But the thing with Trader Joe's is that, and this is why we think they're positioned perfectly to become a big name brand in the United States, is that Trader Joe's does not have the high quality produce like Sprouts. So it always comes back to that. And I think that's why they position themselves well, compared to Amazon and Whole Foods. and Trader Joe's. But maybe Ryan, you can add on any sort of Kroger competition.
I mean, I think Whole Foods is like a legitimate competitor to some extent, where unfortunately we don't get the numbers anymore in terms of like how they're doing relative to Sprouts, but maybe they're targeting a similar customer. I imagine the average income of the Whole Food shopper is probably a little higher than the average income of the Sprouts, but generally a similar customer. With Kroger and Albertsons, I think it's really not it doesn't feel like a direct competition to me. Like just walk into both stores and you're going to see it's just a totally different experience. You're basically getting, what you're going to Kroger for. It's like the overall grocery load, where, like Andrew mentioned earlier, you're not going to Sprouts for the overall grocery load. It's a few unique niche items that you really can't get anywhere else because it's those local suppliers. So, I mean, they've been competing with all these companies for a long time. It seems like a growing subsegment of grocery overall, this health enthusiast, and they've been able to grow comps all this time. It feels to me like there's a massive pie and a growing pie for them to kind of go after. And like I said earlier, it doesn't feel like a winner take all scenario.
Yeah. So 2 things to add on there. First is that they've also mitigated the, I'd say, grocery delivery risk by getting on both Instacart and DoorDash's platforms. They both power the native Sprouts app and website delivery. Plus they're on, as the third-party merchants on DoorDash and Instacart. And I'd say the one thing, so this is actually, recently they mentioned in the investor conference that they were hosted, or excuse me, that they were a part of. Sinclair says that, I think that he might be joking, but I could see him actually do this kind of the Walmart, Sam Walton style, where he said, hey, I walk into a Walmart, I walk into a Kroger, kind of check out what they're doing, check out any updates that they have. And outside of the produce section, which again, you can't just say like I have different tomatoes, but in reality, their, Sprouts tomatoes are going to be much higher quality than a Walmart or a Kroger. And I think their core customer appreciates that. He says he's, I don't know if, there's one item that overlaps, but he says outside of the produce and, the meat and the seafood section, there's not one item that overlaps within these stores. Because, I mean, yeah, like they're going to have garbanzo beans, but the brands are entirely different. There's not any of the same brands. They're all these local ones, all these local, maybe plant-based milks, blah, blah, blah. It's going to be entirely different. So I think that's kind of illustrates Ryan's point of how they're not really competing with a Kroger and Albertsons. They're competing more with Trader Joe's and Whole Foods.
Yeah, he even said he even said, I think at this recent conference, that they are the only grocer he knows of that sells more non-dairy milk than dairy milk. So, I mean, it really is, it's targeting that health enthusiast, the diet specific shopper.
Some people might laugh at that, but those are the ones that they don't really need. Like they're gonna go for the ones that actually, like some people are like, oh, whatever, make fun of that type of stuff, and they can shop at Kroger, but Sprouts, they don't need to have every shopper go there, if you get what I mean.
Is there something I can't get at Sprouts Farmers Market?
Coca-Cola. Like if you're,
so,
that's the big brand CPG is what you're not gonna get.
Well, I'm curious because when I fly out here tomorrow, I'm going to Florida, and I know of a Sprouts Farmers Market. I've never set foot in one. I'm going to set foot in it this weekend. I'm going to do it.
All right.
Well, if you're anything like me, you'll be a little disappointed because I'm not a diet specific shopper. I'm probably the low cost shopper where I kind of like the name brands and I like just going kind of to the Kroger stores, and I went into Sprouts. I'm like, all right, where the hell is everything I want to buy? And so it is like, first, and I know the one in Seattle was like an outlier because it was empty. No one knew what Sprouts was. The distribution centers were so far away, you didn't really trust the product quality. So it was kind of, I don't know, maybe I had a horrible experience, but if you're the typical shopper, it really might not be for you.
Yeah. Okay. So if I am that health conscious consumer, or I'm just going there for food, can I get diapers, toilet paper, and all that? No,
you're not going to get that type of stuff. Yeah, that's actually a good point. So during the pandemic, that's one of the, and it's kind of tough to parse the numbers here. I'm sure if we wanted to get really deep on the analysis, we could go and find that type of stuff. But during the
they don't sell that like that like Honest brand and like special paper. And,
No,
yeah,
so I think that's part of the condensing of the real estate footprint. So that stuff, takes up a lot of space, and it's not going to really drive that much volume. It can sit on the shelves for a long time and not really have inventory turnover that much for, at least maybe not paper towels, but some of those other type of items where during the pandemic, a lot of other companies, a lot of other grocery stores benefited from the paper towels, the toilet paper, the hand sanitizer, all that stuff. And they might sell hand sanitizer in their vitamins and supplements section, but they're not going to, benefit for that. And that's kind of a conscious choice that they have where, okay, we're really going for that farmer's market quality stuff, plus the health enthusiast, and the bulk goods can be sold on, Amazon. And that's another reason, or Costco or wherever. And that's another way that they're trying to differentiate themselves and really not compete with some of these big box, really scaled players.
Maybe they should, toilet paper
actually,
for vegans or.
There actually is a decent like market, but I'm actually like, the more that I'm like thinking about it, I think they actually are competing with like the Krogers and so, because like, if they're not really getting in, like trying to attack Whole Foods, like their customer base, right? Like the idea is that the total availability of these types of stores is still low, right, within the United States, and that they're trying to basically increase the saturation of these types of stores. And so like customers that may not be served very well by their existing options, that would be like kind of white space to move into. Because like I'm looking at their website right now, like a lot of these brands, like I'm familiar with a lot of these brands, and like you can find these at Kroger, at least some of them, right? And these are, you can find these at Whole Foods. There's other, you can find them online, but like you said, the point you made that was interesting was almost that encouraging that like treasure hunting kind of mentality, which I know is something that like a Trader Joe's or a Costco, like that type of consumer behavior that they try to incorporate, because it means you're staying longer in the store, you're being more open to try different things, things like that. Like it can be a very lucrative consumer behavior to tap into, rather than, like you said, like attracting people who are just looking for that one deal for the coupon that they got.
Yeah,
100%.
I could be wrong, but I think Sinclair may have actually used that exact terminology of treasure hunting in.
Yeah, it's a term. It's definitely a term, like treasure. Yeah, I've definitely seen it in a Costco earnings report.
And I think that's a great example of they're really trying to lean into being the opposite of a Kroger. And for any of the audience, we're using Kroger as an example, but it's all sorts of type of stores like that, and leaning more towards that Trader Joe's model, as Andrew mentioned, very helpful workers. You're going to have not the crazy discounts across the store as you go to a Trader Joe's, which really, I think their model is to not have any discounts, but I could be wrong there.
I don't think they discount anything.
Yeah. So it's that type of example. And then they also have been asked about frequently from analysts from time to time now about building out a loyalty program. And we just got an update about that on the, at the investor conference. So they've talked about this a lot. They said that they're building out some sort of loyalty program. They pretty much have one where, I've signed up to their email campaign to kind of track it as an investor, and they've signed up, I think, about 10%, give or take, of their customers in this direct email campaign, so they can track them, have their email, do some direct marketing, stuff like that. And they want to build a loyalty program that they plan to launch in 2024, I believe, but it's a tentative plan. That's not like the Kroger style one where you just put in your phone number and then you get crazy discounts across the store. That's not something they want to build. They want to build something unique. And I think that is an example of where, in the mind of a consumer, they want to continuously reinforce that they're different. Similar, like a Trader Joe's does. They want to reinforce that they're different than the standard grocery store, a Costco, or even an online world, the Amazon, just buy in bulk, economies of scale.
We are getting some, I guess, commentary on that Trader Joe's comparison, because it's not, you're not saying they're exactly the same. It's like they're kind of target audience, right? I haven't been in a Trader Joe's.
I think honestly, you shop at both. Like my mom, when she used to live right by the Sprouts before they closed them down in Seattle, and she'd go to both Trader Joe's and Sprouts because Trader Joe's has that unique stuff that people like, they have the in-house brands, the specialty stuff, all the stuff that people love about Trader Joe's. But again, they don't have the focus on one, the attribute-based items, and two, the great produce selection. So people go to both. And I think they're a very good mix, and they can be a healthy. They've actually mentioned before, it's funny you talk about the Trader Joe's. They said their best performing Sprout stores are the ones that are directly next to a Trader Joe's.
That's funny.
Very
Trader Joe's is
tough.
owned by Aldi, if I remember correctly. Right?
Yeah, and that's a pretty darn good business model. I think they've grown revenue 17% a year for 40 straight years. So if Sprout's going to get anywhere, we think they can
Trader
probably
Joe's?
go. Yeah,
Yeah, gosh, I wish
their volume. I
You
mean,
said they're
it's
owned by Aldi's?
Yeah,
I didn't even
and
know that. Man, they should go public. That'd be
yeah.
nice.
I think they are they public in Europe? I don't know. That's
no,
a
they
whole nother
I feel
flirted
like
with
that's
it.
one of the companies
Yeah.
that will never go public.
Yeah, Trader Joe's.
Just like it's like the Mars of
Chick-fil-A.
groceries. Like Mars
REI,
Mars
yeah.
candy will never go public. Another one.
Yeah,
Chick-fil-A. I'm just saying.
Just
yeah, Chick-fil-A too. Yeah.
a couple or like two quick questions, if you don't mind, real quick. Was the comparable stores sales growth, was that driven by volume or is that driven by price increases?
Yes, this is interesting one. So
They don't break it out.
Yeah, they don't
Okay.
break it out specifically, but they do give commentary on it, where I hope I'm not going to get this backwards, but I think I have it correct. So when inflation hit, they saw a little bit of decrease in basket size for their customers, but traffic has stabilized after they've kind of gotten through that sacrificing of that low, margin customer base. So they had a little bit, traffic's been, I don't know, consistent, give or take, and then basket size was decreasing a little bit, but food inflation was fairly high. And I think that kind of makes sense. People are a little bit cost conscious, especially when some prices of some things were going up 30%. But now, as inflation has come down a bit, they said that they've seen traffic increase a little bit, and they've seen a stabilization of that basket size. So we think that's a good thing. But again, they're not very granular on that. So you kind of have to read into it and trust what they say, because they always, as management teams tend to do, they always try to put a positive spin on it.
No, for sure. I just was curious because, obviously, you prefer to have that be from maybe a little bit mix of volume and price increases rather than just price increases.
Yeah, and part of our
curious.
part of our thesis is that the way they're setting up this good base here of improving the supply chain, there's a lot of things that Sinclair brought in, like for example self-checkout, that he brought over from best practices as a leader of Walmart, a much bigger or Walmart grocery, a much bigger company. There was just a bunch of things to improve shrink, improve the supply chain, improve their store locations, where we think the historical numbers don't look that great, but they're setting themselves up to really have durable comp sales going forward as they build a sustainable model. So we think the future looks a lot brighter than the past, is to sum things up.
And the last question, this one's kind of hard, but so their model is looking at local farms, small farms. There has been a trend to have those farms either shut down or get bought up by larger players. I think that's the most existential threat probably to them right now. Do you know, has management ever said anything about that, or is that an actual issue, or is that not as much of a problem? Do you have any pulse on that?
I don't think they've been asked about it, unless Ryan, do you have any remembering of that? That's a
haven't
good
seen
question.
anything.
You got to hop on the conference call and ask them, because I'd love to know their answer.
And I know it's kind of off base. I just work in an area, so I live in New Mexico. We're very agriculture focused. And I work directly with some people who are lenders to small farms, and they're telling me how bad it is for a lot of small farms out there. That's my personal, there's still, I think, roughly 2 million smaller family farms in the US. So there's still a good number.
Is Sprouts actually sourcing from those? I would imagine that Sprouts would be sourcing from a large organic supplier, not a mom and pop farm.
They do a mix of both. So they that's part of their marketing strategy, is to go after some of these local farms, the smaller farms, and that's part of their way that market to their customer base, because some of their customers are going to say, hey, look, I could go to Kroger style and get the standard stuff, or I could support a local farm. I think that ties into two things. One, it's a better brand proposition for them to separate themselves from the standard grocery store. And two, they can, with their 400 stores, say, hey, we're going to be a big, you go to that local farm and say, hey, we can really, sign a contract here and we can give you half of your volume, for a year here for the specific product. Our customers love it. We can lock you in here, but we're going to have they're going to have really strong margins there. So I think it plays into two things. One, their margin structure, and two, their brand marketing, which all ties together. But I think you're right. That is a risk there long term. They never said anything about it.
No, thanks. No, I didn't expect it's like a super, like you said, it's existential. So I don't know if they can necessarily address it. So it's like they can't control it.
I had a question on there, since I think a large part of the thesis is reliant on store expansion, right? Do you know the economics of a store opening, like when, like payback period,
Ryan's got it, right?
Kind of like implied return on each new, like return on incremental invested capital on each store opening?
Yeah.
I
think you got it's in
I
our.
think it's I think it's about $3 million to open a new store. I have the specific numbers, but
I have the numbers, Ryan, if you want to.
Sure.
Okay.
Go for it.
Okay. So yeah, I have them. And again, we'll send over the show notes. It's just kind of a Substack that anyone can reference, which has all these things. So to build a new store format costs about $3 million up front. And then at maturity, each store does about $16 to $18 million in sales at a 8% EBITDA margin. So that means I don't know, if you kind of think about their EBITDA converting to operating cash flow, which I think should be, fairly equivalent for a per store basis, they generate about 40% of their initial cost in earnings each year at maturity. And I think they say that's at year 4, but give or take, that should be,
I think,
or year 3. Yeah. That should be
by year 3, they expect to be ramped to that 1.36 million number on EBITDA.
Yeah, and it depends what area they're opening in, because they say that when they open in Phoenix or Southern California, where they already have their brand is well known among a lot of the people out there, they're going to ramp a lot quicker. If they're going into a middle of the pack kind of new place like Florida, it's going to be a little bit slower. But if they're opening some of these new markets like the Mid-Atlantic and the New York State area, it's going to be a lot longer because they have to build up that marketing base as they go along.
Okay. It sounds like it's probably a 3 or 4 year payback period.
Yeah, 100%. Yeah. The returns on invested capital are not crazy good, but given the price we pay here, and the reinvestment runway, we think, I think that what gets us, excited about this company is not generally the return on invested capital, which is, it's solid, I believe. And they've calculated a few different ways, and you can calculate a little bit different than them. They kind of give an adjusted number. It's somewhere around 12 to 16%, but the reinvestment runway is what gets us excited, because they think there's a room for about 1,300 stores across the United States, given the demographics of what they're targeting versus kind of a real estate, census kind of read through. And that would be just about triple the store count today.
And I think that's a really good segue into valuation. So how are you guys penciling this out?
Yeah, Ryan did the math on this for the report a few weeks ago, so maybe.
And I want to disclose to everyone, this is a holding for you guys currently.
Oh yeah, definitely. We should say that we do own shares at the moment.
Okay.
Yeah, what, 6% of the fund?
5, 6. Yeah, and so yeah, we are biased here. We may or may not. By the time you're watching this, we may have sold it. We may not. We may have bought more. All that good stuff. We are biased here. But yeah, Ryan, do you have the numbers on the report to look at?
Yeah, so we just kind of, and we don't do, I think you guys, judging from what you said last time we spoke, Fabio, it sounds like you guys do a little more modeling than we do. We kind of just come to some basic assumptions and basically say, do we think these are reasonable? And if it happens, what's kind of our IRR? And so our projection here, well, I'll just say what we come out to if you put these in. So 10% annual store count growth, that might be aggressive. We'll see. I think they can definitely hit it for the next 2 years at least. And it's kind of hard to project anything out from there, but they say they can do it for, I think they've said the next 5 or so years, they expect 10% annual store growth. We put in 3% comp sales. Once again, it's a grocer. A lot of that is predicated on food inflation. So who really knows? We have operating margins steady, which, you know, we talked about this earlier, where that's probably the biggest fluctuation is, if margins contract, that's probably where a lot of that short interest comes from, is they just don't believe margins can stay that high for so long. So steady operating margins, 3% comps, 10% unit growth. We get to basically 15% IRR on that, assuming the operating cash flow multiple is similar in what's the exit year here, 2027. So that's kind of what we look for in a hurdle rate, is around 15%. That's what we want to get to. It's, you know, obviously not always going to get it, but we think those are reasonable assumptions. It isn't as cheap as when we bought it. It was a little easier to underwrite that, but I think today it's still reasonable to get low teens to mid teens IRR.
One thing that Ryan forgot to add is the 5% annual share count reduction. That would be what we're penciling out. And it's basically what they're telegraphing to investors is, if you look at what they're going to say they're going to spend on CapEx and then what the excess cash is going to be, you know, versus the price today, they can probably reduce it by about 5% a year. But again, that does depend on where the stock price is trading. If it drops lower, which, you know, we think is kind of a good thing about an investment like this, is the lower the price is, the better the buyback is going to work, where that just gives you a much more margin of safety. You know, they could reduce it by 10% a year, the lower it goes. But if it goes higher, which is probably a good problem for us to have as shareholders, they're not going to be able to reduce it by that much. The forward returns will be lower.
It reduces that coiled spring, unfortunately, but still, yeah,
That's right.
it's still going higher. Yeah, we were talking about that with Musa yesterday. And today again, by the way. I don't
Did
know
it go up again?
Yeah, about another three something percent.
Wow.
So if you go on the week, it's
And we're very unbiased on Musa. None of us told
very
Musa off.
yeah, none of us have Musa. Okay, so they have the buyback story. Do they have by chance a policy on the buyback beyond just a excess of CapEx, something that investor, so an example is there's a which is another company, I think, if you guys are ever up for it as a pitch, it's you know, a little bit more on the scandalous side, but they are RCI Hospitality. Have you heard of them?
Yeah, well, we have heard of them.
Brett knows them really well.
Oh,
yeah, no, that is a joke, but they're nowhere near. They're 2,000 miles away from us.
Our members are gonna love you, man.
Yeah, we have had someone on, I think 2 years ago, talking about that, so could be time for an update with that one.
Well,
so yeah,
we're
not opposed.
They provide a buyback strategy, or like a range, a buying range to investors. Practically, it's almost like management telling you, hey, buy the stock when it's in this range, which is really interesting.
They don't
this price.
They don't do that. I believe when the buyback ends, they kind of just do a new authorization, but I think their story is more of a consistency play. They did stop it during the pandemic for a little bit, like most companies did, but theirs is more of a consistency thing. I would be a little hesitant. Like, what's interesting is we've never seen their stock at a premium valuation. So I don't know how they would act if the stock got up there. Maybe they would continue to buy back stock. But what we like about that is the consistency, is that, okay, we know that they're going to spend this amount on CapEx because they're opening these stores, and the rest of it, we can really say, okay, they're definitely repurchasing stock. It's going to go down by this amount, however they're spending it. And if the valuation's low, well, it's probably going to be, at least if we're right about the business, going to be a good move.
Yeah, I think they're, unless the multiple got down to, like, I don't know, something crazy like 5 times or something like that, their first priority is opening new stores if they see a clear opportunity for it. If it feels like the right fit, that's where they're going to deploy capital first. Like I said, it might change if it just got to a dirt cheap multiple, but that hasn't happened in a little while. So for the time being, it seems like kind of a balanced strategy.
Yeah, so they'd rather invest in new stores where they're going to get a more, let's say, a known return. And okay, I like that, because I don't like businesses that forego their investment in their business in order to just buy back shares. So
Meta.
good to know that. Which company?
I said Meta. Meta
Oh.
back in like 2021, was it?
Hey.
That one,
Hey.
yeah, that one crazy quarter. That one.
I bought them after that. I forgave
No,
them.
I did too, but
I forgave them. I looked past it, but they
Hey,
make
that
mistakes.
CFO is not there anymore, right?
Yeah.
So I think that might have
Yeah.
been why they had to leave.
Yeah, let's blame it on that.
Yeah.
But okay, so what would be something that you guys would see that would make you more bullish on it and increase your allocation? So is there something that the company could show you and saying, oh wow, okay, we need to actually up our allocation here? And what is something that would do the opposite? Say, okay, we need to reevaluate this and lower our exposure.
Yeah, Ryan, you want to go first, or?
I think for me, the biggest thing I'm watching on the risk side of things is, because they don't explicitly break it out on the comp sales, like, is there any chance that inflation is masquerading slower foot traffic? Like that's kind of my concern. It doesn't seem like that's the case. And as long as they're generating positive comps and positive operating income growth, it doesn't really concern me. But I don't know, if inflation got real out of hand and they saw a huge bump in their cost of goods sold and they're generating like 2% comps, then I think that's a pretty big concern for me.
Yeah, and I would say, yeah, inflation dependent and obviously price dependent when we would want to add. But what would get me more excited about this business is consistent comp sales in the 3 to 4% range, because historically, or at least before, kind of the 2016, or excuse me, after the 2016 period, they're really at 1 to 2% a year besides the COVID bullwhip. And if they got to 3 to 4%, I think investors may be underrating how much that can help with their operating leverage, because again, they have the higher gross margin profile, but their operating margins really aren't that strong. And if they can consistently grow comp sales at 3 to 4% a year, and maybe grow comp sales even above inflation, which would be a nice little, I think, boost, they could get their operating margins into the 7-8% range, which would really, I mean, that would just make the numbers look way, way better. And then on the opposite side, I think if Sinclair left, which he's the CEO and he's done a ton for this turnaround here, he's really succeeded. I think if he left, that would be a big warning sign. And then it's just the opposite of the comp sales. So I think, we kind of look at operating margins, look at operating income per store, we look at kind of the return on invested capital, but a lot of that all comes back to the comp sales. So that's the key number for us is how are the comp sales doing relative to inflation?
Oh, I see Leo shared that. Is that something you want me to bring up, Leo, or just keep it there?
You can bring it up.
Yeah,
a recent Reddit thread from 3 months ago from Ask Los Angeles. Why isn't Sprouts busier?
It's some LaFufu analysis. Let's go.
Post for sure.
That's true.
Definitely tongue in cheek.
That's honestly our thesis is that people don't understand the brand yet, and the new management team slowly over time is gonna make sure people understand that, hey, it's like there's a lot of you out there that want to shop here, you just don't know yet.
Yeah, I mean, I've never
on the ground.
I've never been there, so I'm gonna visit it today. Oh, not today. Sorry, this week.
Yeah, I'm right after the stream.
Yeah,
Must have been a pretty good pitch.
Well, I gotta see what it's all about. I don't know if there's one near me right now, but I know of one, and I know exactly where it is in Florida, and I'm gonna go to that one in particular. So I'm gonna find time out of my day on Friday or Saturday.
I think there's a website that you can go to that actually shows all of the Sprouts locations in the United States.
Yeah, and hey,
problem, Fabio.
Both Texas and Florida are their expansion markets, according to them. So, hey, they might be there, or there might be one coming soon.
There's definitely one here. I just won't be here for it because I'm leaving tomorrow. So, if I was
stop on the way out,
Fabio's a Whole Foods shopper, so.
Well, I mean, with the size of the Amazon position, then I appreciate that.
Yeah. Well, you're supporting the team, you know.
Yeah, exactly.
Just money out of one pocket into the other.
Yeah.
That's right.
Yeah, I got to pay myself back a little bit. It's like a cashback card, you know.
Yeah.
If you don't mind, I do want to respect you guys' time because I know we're hitting like a little bit past an hour. I don't want to hold you too long. I did have one quick question though. Something that does seem like pretty relevant is how are they going to grow their internal brand, their Sprouts brand? Do you see that growing at like a decent clip, or what's the plan they have to do that?
So on the recent investor conference, they said they're not going to grow it as much as a Trader Joe's, which would be pretty extreme, you know, at 70, 80%. But they say they want to keep investing in it. It's going to have higher margins. They can kind of go direct to those farmers and have those direct relationship with, again, those local farmers, like you mentioned before. They haven't given out a specific number, but hey, it's incrementally grown from 14% to 20% over the last few years. And I see no reason why it's going to slow down. And I think what's key about that is that when people, as Ryan mentioned, one of the tough things about going to a Sprouts is you don't recognize the brand. But if people trust the Sprouts brand, then they know, okay, this is kind of be the standard thing in the store. I can get my basic, you know, the stuff there that I want. I know that I can trust that it'll be this, you know, it's not going to be Kirkland's Signature level or Trader Joe's level, but it can be very helpful, I think, for them going forward. Ryan, did you have anything else there?
No, I think that covers it pretty well.
No, that's perfect. I appreciate it.
All right. What's the best way for the audience to find you?
Chit Chat Money on any of your podcast players.
Yeah.
Or we're on Twitter.
Yeah, we are on Twitter as well. And then for people that aren't on Twitter or X, whatever you want to call it, we do have a Substack, which is a great way to follow the show. We just do a recap newsletter, linking out everything. And then on the Tuesday shows, which again is what we do that's kind of what we did the Sprouts one style as. We put out our show notes along with the episode. So if you subscribe there, that's also an easy way to keep up with us.
In fact, I'll ask you guys after the show to send me all these links so I can post it in the description.
All right. That'd be great.
Will do.
All right. So thank you guys so much for watching. Whoever watched live, I see all you guys, and thank you for the questions that you guys were asking. And yeah, be sure to check these guys out at Chit Chat Money, Twitter, YouTube, or all podcast platforms. With that being said, we'll see you guys on the next one.